Hey, what's up guys? Nicholas Davenport here, aka Mr. Mental Muscle. We have another episode today on the Mental Breakdown channel. Now, I've been seeing in the news talks about FTX and them filing for bankruptcy. Now, I don't want to get into the economics of that. I want to get into what we see in the actual occurrence of why do people get into cryptocurrency or things such of that nature, things like even the lottery. We get drawn to this. Now, people were trying to be the next crypto millionaire, investing in things like Bitcoin, Shiba Inu, and other popular coins that people were trading. But what attracts us to it? Let's look at the psychology and the science of that. So let's start off with the actual what happened. To give you a little backstory, FTX is a crypto exchange. So what that means is it's a place where people can trade, sell, and buy cryptocurrency, kind of like a stock exchange. Now there's several other ones such as Coinbase, but basically this one grew in about 2019 and it was started by Sam Bankman-Fried, and he comes from a pretty illustrious background. Both his parents were lawyers, taught at Stanford. He himself is from Stanford. He went to MIT and got a degree in physics, so he's a pretty smart guy. Now, over the years, after starting FTX, it rose and billions of dollars have been made off of it. Even top celebrities and athletes have invested or have been paid as influencer to promote it and gotten stake in the company. You can see it's a pretty big deal. Now, I can see in 2022 now it's filing for bankruptcy because it's been a rise and fall of cryptocurrency. Now, back in 2019 when FTX started, the most popular cryptocurrency, Bitcoin, was about $10,000 per coin, and it ended up going in 2021 to about $64,000 a coin. You can see that extreme increase, but now it's falling down to about $16,000 per coin, and so has every other cryptocurrency behind it. Now, you can see this could be troubling when your business is based on the ability to trade this type of currency. So if popularity goes down, people aren't trading, how can you make money? And that's kind of discrepancy because they went ahead and made their own cryptocurrency called FTT. And you can see how this could dilute the pool a little bit because if the currency is going down, what is your money really worth? And there is even a leak from Bankman-Fried's original company, Alameda Research, by someone named Changpeng Zhao, or CZ, and it showed the balance sheet. So like I said, I'm not getting too much into economics, but just make sense of business. You need to have to account for what you're buying, selling, own, don't own. It has to make sense because the SEC is going to have a say in that. Now, this is the crazy thing about crypto. It's supposed to be something that's more clandestine. So if you're making sales, trades, it's not being tracked back to a central unit. Because if you think about the banking system, it's big business because making money in the banking system is a lot of exchange of currency. Now, that was the whole point of crypto, to get away from that centralized system so no one can really oversee it. But this is where the trade-off is. Now, looking at all this, you can understand why this is not a good look for FTX, because having gaps in their income and their revenue, not being able to make the money when there's people who have actual money invested, so they're going to take a loss, people rushing to get their money out, it doesn't look good. And adding on that they have an $8 billion gap in what they need to account for as far as their revenue. So all in all, doesn't look good. But like I said, this was not really about that part. The point is, crypto became so popular. A lot of people are trying to make money, something like a get-rich-quick scheme. Now, let's look at what people might be drawn to in these types of situations. First one, if you've ever heard of something like the bandwagon effect, now this is a cognitive bias where people tend to follow on trends because they're popular, and this is not uncommon. Most people like to do what everyone else is doing, and there's nothing wrong with that, and it makes sense in a lot of ways depending on what it is. But in the case of crypto, why were they jumping on so fast? Now, FOMO is a sub-facet of bandwagoning, so that's the fear of missing out. People get scared. If I don't get on this right now, will I be able to make that money? Will I be able to get my life in a better order? So it drew a lot of people to it. Now, you can see this carry over a lot in the lottery. That's why I brought it up, because there's a lot of similarities. People trying to get a lot of money in a short amount of time. Now, crypto is, I guess, a fancier way using tech terms and blockchain and all that to make it dressed up as a better appeal. But at the end of the day, I thought it was pretty much the same thing. It's a gamble. You don't know where it's going. I don't fully understand it. And I would argue most people don't understand it. That's the Dunning-Kruger effect, but that's a whole other video. But basically, going back to the lottery, why do we care about these things? Lottery, crypto, making money fast. Well, I think the biggest appeal is a jackpot. Everyone wants the big picture. Who wants to get a little here, a little there, when they can get the whole shebang-a-bang, right? So think about that. That draws people. If they can get out of financial strain, most people are living a median income in America about $50,000 a year. Now, it's not saying it's the end of the world, but it's not something you can dramatically live off and have a lavish lifestyle. And that's very appealing. We see celebrities, we see famous people we like to follow, and we want to live that lifestyle too. So it's very attractive to see that you have an opportunity to do that. Now, another part I think that draws people to these type of situations is they don't really think about the odds. Like winning a lottery is about 1 in like 300 million. Becoming a crypto millionaire is not that common, but we get caught up in the fact that it did happen. Now there's two biases we can talk about here. One's the availability heuristic and the other is survivorship bias. So with the availability heuristic, this basically is saying that we generally draw on the information that's readily available in our head. If we hear about someone who won $1 billion jackpot, we don't hear about the 200 million other people that played the lottery or invested in Bitcoin who didn't become millionaires or billionaires. So we easily can say, oh, I know someone who won, or you heard of someone who won. So you eradicate what could really go wrong in the negative aspect. So when we see these occurrences happen, it minimalizes the fact that it's more likely to go the other way negatively and not winning than it would be to be positive winning the big jackpot. Think about something like plane crashes versus car crashes. A lot of people are scared to fly because of a plane crash. But statistically speaking, you're more likely to die in a car crash than a plane crash. Matter of fact, a plane crash is about 1 in 11 million, while a car crash death is about 1 in 53,000. So you can see the likeliness is way higher with the car crash. But in a car crash, you can say something like, I have more control since you're the one driving other than the pilot. Also, you're on the ground, so you can, turn, steer out of it maybe. So that maybe give you a better sense. But at the end of the day, the information is a plane crash gets reported way more than a car crash on a bigger scale. Just like with the lottery. You're going to hear someone win the lottery, oh my God, jackpot won, but you're not going to hear 200 million people in South Florida did not win today. It's not going to happen. So this is why our brain likes to shift to that. So this goes to the other side of it, which is survivorship bias, and it has some of the same points. We only tend to see the ones who win. Just like celebrities, we see people on TV, movies, and it's like, oh my gosh, they're famous, they worked hard, they paid their dues, slept in the car, and they made it. But we don't see the 20,000 people a day that go to Hollywood that end up being waitresses or servers or bartenders, and we never hear of them. So taking that information, you can think like, I'm more likely to probably not to win. But we live on that because we thrive to say the judgment is I'd rather win, so we want to agree with that. Now, the last part, this kind of correlates with the lottery as well as crypto, and why we get into these things is there's small, inconsistent rewards that we do get that keep us going. So you have a scratch off or play the numbers, you might win $20 here, $100 there. It's not a lot, it's not going to change your life, but it gives you that feedback of like, I got this. If I keep trying, maybe I'll get the big show. But this is just a operant conditioning tactic. This is a schedule of reinforcement. So let's talk about that a little bit. So with schedules of reinforcement, we'll talk about two right now: fixed ratio and variable ratio. So with a fixed ratio, that means there's a set amount of attempts to give you some kind of feedback or reward. Say you have a job as a salesman and they say if you make 10 sales, you'll get a $500 bonus. So after 10 sales, you get that $500. That's motivating you to make sales so you can make the bigger picture for the company, but then you get rewarded too with that 500. Not bad, right? So it's fixed. There's a set amount of times, or sales in this case, to say that you'll get this reward. Now, on the other side of variable ratio, this is an unknown amount of attempts. So let's say a slot machine. Perfect example in another gambling concept. So every time you pull a slot machine, it might take 18 pulls, might take 200 pulls, but eventually the payout's gonna come. But since it's a variable, you don't know when it's gonna come. You can't sit there and say, okay, let me keep pulling. So we're reinforcing your brain, talk about dopamine, right? It's saying, if I just keep going, I'll eventually win. And you might get a little payout, might make 50 here, 20 there, 100 here, 100 there, but you're not gonna get the big $1 million payout, but your brain's getting fed that it might happen. So crypto, we saw this in the different countries because a lot of new cryptos will come out and they'll tell you it's the next big thing. Companies and hedge funds will put lots of money into it, and you saw the prices spike up. You're like, oh, you got to get on. And guess what? That got you bought in, but then it wasn't the same payout. And then those guys got to get their money out and made their profits while most people didn't. So this is where I think it gets confused a lot. And our brains is very good at detecting errors, but sometimes it makes lapses in judgments because of these fallacies. And I guess that could segue perfectly into this last example, is the hot hand fallacy. So it's going back to like a gambling concept. If you win a craps table and you're like, I'm on a streak, this is a misconception. There's no rhyme or reason to how those dice are rolling unless you're cheating. So how do you know if you're gonna win again? But we trick ourselves to think, if I won this time, I'm probably gonna win again. I run 10 times in a row, I'm definitely gonna win this next roll, but those 10 previous rolls aren't gonna necessarily affect the next roll. And this is what happened in crypto. I saw it personally. I'm even guilty of investing a little too. And there's nothing wrong with that if you did. So don't think that's what this is talking about. But you can see how I invested, say, $100. It went up and now I had $300. Oh my gosh, let me put another $100. It went up, I got $600 and so forth. But eventually you keep putting in thinking you're hot. It doesn't necessarily dictate what's going to happen in the market. And with crypto, a very volatile, unbalanced market, it crashed and it went down severely. So you can see how the high-hat fallacy can trick your brain to thinking, oh, if I won this many times, I'm going to win the next one. Same thing in sports. People on a streak shooting wise and like basketball, he can't miss, right? But then he misses. And if you bet on that, you lost your money. So think about this, guys, because the brain is a very interesting thing. That's why I love talking about psychology and these topics. So if you have any other suggestions in this realm, crypto was a very different topic I went on, so I thought it was cool to cover. Let me know in the comments below. Make sure you like, comment, subscribe, and share this video. And thanks as always, guys, for letting me break it down and get your mind right.